Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Nishant, Pant, author of Mean Reversion Trading Using Options. He joins me to discuss why every investor should have options in their portfolio. Nishant, it's great to have you with us. Welcome to Trade Talks.
Same here, same here. Thank you for having me.
You got it. And portfolios are more than just having equities within them. Why should every investor leverage options in their portfolio?
Yeah, so if you read any literature on investment, they'll tell you don't put all your eggs in one basket. While this means don't bet the farm on a single investment, it also means having different strategies in your investment portfolio. Now, we are all used to the process of home buying, and we use leverage all the time. So I'll give you an example. So let's say you're buying a $300,000 house, and with the 10% down payment, you are putting down only $30,000 from your $30,000 cash. Now, if that house doubles in value in 7 to 10 years, that would mean a 900% return on investment. So you put down only 30,000, and the house sells for 600,000 in 7 to 10 years. You can pocket $300,000. So this is a classic use of leverage, which we are all used to. But many investors are not familiar that a similar concept exists when investing in the stock market using something called options. And I'll give you an example of how you can use options in the stock market. So let's take an example of a stock like Costco. Let's say you want to invest in the stock market and you like Costco, you want to buy some shares of Costco. Now, if you look up Costco's shares price right now, it's almost at $500 per share. If you were to buy 100 shares of Costco, that would mean putting up $50,000 to just buy those 100 shares. Now, this $50,000 is more than the house payment, the down payment on that house, that example I gave you, which was only $30,000. Now, if you also pull up the chart of Costco, Costco has never traded above $600 per share in the last 20 years. So if you are buying 100 shares of Costco at $500 per share, and you're putting up $50,000. Now, let's pretend that magically Costco goes up back to its all-time high of $600 per share, and you are in 1 year and you are able to sell it. How much money would you make? So $600 per share times 100 shares, you would sell it for $60,000. You put up $50,000, so you made a profit of $10,000. Now, okay, fine, that's a 20% return. But I gave you the best case scenario where Costco is going back to its all-time high. It could just go $20 per share in 1 year, or it could even go down. Now, if it goes above, if it goes $20 per share, then the return on your investment is only $2,000 for the entire year, which is a measly 4%. Mm-hmm. So traditionally, buying a stock, you would face problems like this. You would put up so much money, and the returns that you get are just not worth the amount you are risking. So now let's switch to an example of something called options, and I will show you how nice using leverage correctly can how can it help you with the investment?
So Nishant, let me stop you there for a minute. So when you're trading the options, you're actually trading the premium. You're, just to be clear for the audience, you're not trading the underlying. You're trading and using the leverage on the premium of the options.
Yes. So options are also called derivatives. So they don't have any value on their own. They derive their value from the underlying stock. So instead of buying the stock, you actually buy options. And it's a similar example, like the house example I gave you, right? You're not putting up the entire amount to buy the house. You're just putting a down payment, but you're controlling the underlying asset as if you had purchased the entire asset. So the concept is very similar. So with options, not getting into too much technical details, but there is a trade structure called a vertical spread. Now, if you use the same example of Costco, The beauty of using vertical spreads is that you can decide how much money you want to risk. So if you want, you can risk as little as $50 per trade. Whereas if you were buying stock, let's say the example of Costco, where it was trading at $500 per share, you at the minimum, you have to put up $500 to buy just one share. So with options, you can decide. So you can go as low as 50 and there is no upper limit. So now to compare apples to apples, let's say, although you could risk just $50, but let's say you were risking $10,000 to buy something called a vertical spread on Costco. Now, if Costco moves just $5 in 1 month, if you use a vertical spread, you can double your money in 1 month. So you put up 10,000, and if Costco moves only $5 per month, you can make 10,000 on that investment. That's a gigantic amount of returns. And if you analyze it, it'll be like, I don't know, like 4,000% return or something like that. Right. So any questions?
So, and just to provide a little bit more context here with the vertical spread, you also have a risk management control built in there, because you're not just, long or short an option. You actually have that hedge in there because of the nature of vertical spread. Yeah. So, so the way vertical spreads work is like you were saying, it's called a defined risk trade. So you're buying a vertical spread, and the amount of money you put up is the only money you can lose by definition, because you're buying something. And then having a trading strategy, that's just a trade structure. That's not a trade strategy. If you want to invest in the stock market, there is something called positive expectancy. So any trading strategy you pick up should have positive expectancy, which means that your wins must add up to more than the losses. Because, investing in the stock market, you are in the game of losing. The only thing you need to make sure is you win more than you lose. So as long as you have a trading plan in place, and for example, the trading plan I use is every winner doubles my money and every loser is cut at half. So if I lose half of my investment, I cut that trade. So theoretically, every winner cancels out 2 losers. So that's how I develop positive expectancy in my portfolio. Does that make sense? Yes, it totally makes sense. And we appreciate the insight, Nishant. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Okay, thank you.